Ladies and gentlemen, good day and welcome to Prince Pipes and Fittings Limited Q1 FY23 earnings conference call hosted by JM Financial Institutional Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vineet Shankar from JM Financial. Thank you, and over to you, sir.
Good morning, everyone. We welcome you all to the conference call with management of Prince Pipes and Fittings Limited to discuss the financial performance of Q1 FY23 and business outlook. From the management, we have Mr. Parag Chheda, Joint Managing Director, Mr. Shyam Sharda, CFO, Mr. Anand Gupta, Deputy CFO, and Mr. Nihar Chheda, Vice President Strategy. I now hand over the call to Mr. Chheda for his initial remarks, after which we'll move on to the Q&A session. Over to you, sir.
Good morning. Thank you all for joining us on our Q1 FY23 earnings call. The presentation and the press release have been issued to the stock exchanges and uploaded on our website. I trust all of you have had the opportunity to go through the same. Let me start by giving you a macro view of the industry and then diving into the company level performance and the strategic going forward. Q1 of FY23 has been a challenging quarter for the industry as agri demand continued to be weak while the demand for plumbing and SWR was resilient. In addition, the persistent softening in PVC prices resulted in a muted sentiment across the value chain, causing destocking amongst our channel partners. Despite the challenges, we continue to aggressively expand our volumes and increase our market share. During the quarter, our volume and value grew by 69% and 83% respectively, led by outperformance in the building material segment of our portfolio. However, as you are aware, the quarter witnessed inventory loss, led by constant falling of raw material prices, which has been a phenomena across the industry. We were impacted to a greater extent due to the higher inventory as of 31st March. The inventory losses are likely to impact the second quarter as well due to the sharp price correction in PVC in the July month too. We now believe the prices have more or less stabilized and are close to bottom. In the coming times, as prices stabilize, our channel partners will start restocking. We also believe that our margins will begin to recover from the December quarter. I would like to highlight that while the price correction led to a sharp inventory losses in the short term, the current price regime will create a strong demand environment for the industry. At these levels of PVC, we expect robust demand to be driven across segments of plumbing, SWR, as well as agri. We strongly believe we are well poised to capture this growth due to A, the new capacities set up at Jaipur and Telangana facilities, as well as B, widely expanding distribution network across the country. Furthermore, our business outlook continues to be positive. Prince Pipes continues its vision to aggressively grow the piping systems business and diversify into complementary verticals. In May this year, we had launched PE Fit Aqua, which is our HDP piping solutions and Corfit manhole chambers. I'm glad to share that both these products have received a good acceptance and we are gaining steady traction for these in the institutional as well as private developer segments. We are now in the midst of implementing several growth-oriented strategic efforts, some of which were discussed on the last quarter call, like digitalizing our value chain, launching newer applications, and we thus continue to enlarge our product basket as our focus remains on growing our value-added product portfolio to the overall sales mix. I'm happy to share that we've announced our foray into the bathware segment, making our presence in the front of the wall category and a natural extension of our business. This organic expansion of our product portfolio into faucets and sanitary ware allows us to leverage the strong equity of the Prince brand in the building solutions market and will help our channel partners to expand their business. It is our endeavor to offer a wide choice of bathware solution to Indian homeowners and architects as we will roll out the latest range of products in line with global lifestyle trends. As per market estimates, the overall market size of bathware segment is about 15,000 crores, with organized market in the range of about 65% and balance 35% being the unorganized market. We are in the process of developing this vertical and have hired a seasoned professional with over 15 years of relevant experience. We are formalizing a progression plan based on building an asset-light model and capitalizing on our growing dealership network. We shall share further details at a later stage following the completion of regulatory and necessary approvals. I would like to also share that we have been making steady progress on growing our B2B segment. Even though we have begun work with reputed institutions and builders, there is a great scope on growing this business segment. We will continue to put adequate thrust to ensure that the B2B segment is a key growth enabler for us. Guided by our strong set of corporate values, a talented team, and successful execution of our key strategies, we have been navigating the environment well, despite industry headwinds. With strong business fundamentals and an exciting India opportunity, we remain optimistic as we leverage our strengths to achieve higher growth and create greater shareholder value. Thank you for your time and mind share. I will now hand it over to Shyam to take you through the key financial highlights.
Thank you, Parag Bhai, and good morning, friends. I'll be taking you through Q1 FY23 financials now. In this quarter, the company saw a revenue growth of 83% at 604 odd crores compared to 331 crores in Q1 FY22. Volume grew by a robust 69% at approximately 31,250 metric tons. Coming to EBITDA, it stood at 44 crores for Q1 compared to 41 crores in Q1 FY22, indicating a growth of 6%. EBITDA margin stood at 7.3% for this quarter. Profit after tax stood at 16 crores compared to 18 crores in the corresponding quarter. On the working capital front, during the quarter, the working capital days have increased to 88 days from 68 days in March 22, but our inventory days have improved to 78 days from 85 days at the end of March 22. Given the volatile raw material supply situation, we have higher inventory levels which are being rationalized and we will return to normal levels by Q2. With constant emphasis, our creditors has improved to 38 days and our debtors to 48 days. Our endeavor going forward is to further improve our collection, thereby reducing our debtors days. The company had issued and allotted 507 units of commercial papers of rupees 5 lakh each
aggregating to rupees 25.35 crores. The commercial paper was issued on May 11, 2022 and has been successfully repaid on August 5, 2022. With this, we would like to open the floor for the questions, please. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Hello.
Dhaval, can I request you to talk a little louder, please?
Yeah, hello. Am I audible? Hello.
Yes.
Yeah. Hi. Okay, just one question. Given the PVC prices are falling, the realization per kilo seems to be broadly stable. So when do we start seeing the impact of this in the numbers?
Sure. Thank you, Dhaval. So the realization impact of the fall in the raw material prices will be seen in the September quarter. And I would also, in fact, like to highlight that the margin pressure will continue in the September quarter, and then from the December quarter, the margins will begin to normalize. This is because if you see the trend of the PVC prices, the largest drop has actually been in the month of July. So July has been the worst month of the financial year. We do believe that PVC prices are now close to bottom, and August and September should more or less be stable, which bodes well for the business going forward. In terms of an affordable PVC price regime, should drive a better demand going forward across segments.
Yes. So a comparison to we last almost 6-8 quarters we were seeing an increasing trend of PVC prices just after the first lockdown. So before COVID, our realization per kilo used to be around 130, 125, 130 range. And now we are at 193 for the June reported quarter. Now in this we've seen a transition, with the share of CPVC increasing, share of fittings increasing, which are much higher value-added products. So on a like-to-like basis, if you were to see, where are the PVC prices compared to the pre-COVID, the December 19 or the March 20 quarter, and what would be the realization per kilo, if we keep the same PVC prices?
So the PVC prices currently are obviously much lower than what it was over the past few quarters, but it is still higher than what it was pre-COVID. So traditionally, PVC prices would be in the range of, I'm just giving a rough estimate, would be in the range of 70 to 75 rupees per kg, which today would be around 93 to 95 rupees per kg, which we feel is close to bottom for the next couple of months. So that's the differential. On realizations, I think will not comment now, and it's better at the end of the quarter. We would also have a better clarity.
Sure. So last question. So over September, so now what sort of drop in realizations should we expect? So which is 193. So any broad direction if you can give?
So it will be lower than 193. If you're asking for a broad direction, it will be significantly lower than the quarter one realization, because like I said, a large drop has happened in July quarter. I will not be in a position to quantify it because we are not even done with one half of the quarter.
Correct.
But it will be, to answer your question, broad direction will be lower than Q1.
Okay. And this and how would that be reflected in a long-term trend for EBITDA per kilo? Because we've seen again a very wide range in EBITDA per kilo also. So any long-term sustainable number as a company, what would you be looking at?
Yeah. So if in the September quarter, the EBITDA will be under pressure because of the inventory losses extending into July month. But on a long-term basis, I think from December quarter, our usual EBITDA guidance of 13 to 15% seems achievable at this point.
And on per kilo basis, around 18 to 20 rupees per kilo would be a right figure?
It's a larger range than that. I think we would stick to a margin guidance of 13 to 15.
Okay. Fine. Thank you very much.
Thank you.
Thank you. Next question is from the line of Sujit Jain from ASK Investment Managers. Please go ahead.
Hi, Nihar. If you can quantify the inventory losses in the quarter.
Yeah. Sujit, the inventory loss would be in the range of 30 to 35 crores for the quarter.
Okay. And industry volume degrowth QOQ. So we said that we could have gained market share. In your opinion, what would be the volume degrowth that would have happened QOQ?
I think, Sujit, thank you for that question. I think it's important to highlight that in our industry, Q1 volume growth cannot be seen on a Q1Q basis because quarter one is always going to be very heavy. And quarter one is usually light for us, especially since we are not very heavy on the agriculture segment. It's better to see volume growth on a year-on-year basis. And last year, of course, the base is really small, so that wouldn't be a fair comparison either because of the impact of COVID, etc. But if you see the last 2 or 3 year CAGRs of volume on a annualized basis, we have been gaining market share consistently.
In your sense, whichever number we may look at, the industry would have fallen more YOY or QOQ for the quarter.
So if you see YOY, there has been a growth for us, which we believe is higher than the industry.
Sorry, QOQ, yeah, right. I'm asking industry would have fallen more QOQ, most likely.
What I'm trying to say is I think Q1Q is not really relevant because players who are having more dependence on the agriculture segment, which is a seasonal business, will always have a lower drop from Q4 to Q1 because Q1 is very heavy on the agri business. For us, it contributes to maybe only around 33% of our business. So Q1 is always going to be lighter for us basis Q4. So it would not be the right comparison to look at volumes on a Q1Q basis, especially for Q4 to Q1. Historically, if you see the trend for us over the past 5 years, Q4 will always be much, much higher than Q1. And that continues to stay true.
Sure, got that. And now, when I add back 35 crores to your OP, your operating profit margin would have been 13.1%. That still looks a lower side on the typical, 13 to 15% kind of range that we target. Is there any other one-off or any other item you would like to highlight which would have impacted the operating margin for the quarter?
So one, obviously, like you said, is inventory loss. The second is, obviously, the volumes are still not at the desired level because of the continuous fall in PVC prices. The sentiment in the channel has been negative, which leads to destocking, as a result of which there was not a very strong pull for sales, which is usually there. So in terms of operating leverage and cost absorption, also that has been impacted due to the, I would say, maybe suboptimal volumes as a result of destocking, which I believe should reverse in now the coming weeks and months.
Right. And the net working capital increase, despite your commentary, last quarter that was the peak. So how do you view the net working capital now?
Yeah. So I think, Sujit, I prefer to look at working capital in terms of receivables, because that's the only genuine reduction in receivables which we are able to drive, which has gone from around 60 days to 48 days. The increase in working capital has happened because of a reduction in the creditor days, which really is not in our hands because it's a function of our buying pattern. And inventory also has reduced from 85 to 78 days, which will continue to reduce and will be at a much lower number as of the end of the quarter. So the genuine improvement in working capital is in receivables days on a long-term basis, I'm saying, which has incrementally improved from March. And, we are not happy with where our current receivables days are. It has to improve and we are very far from where our peers are. So that's something that we have recognized and appreciated internally. And over the long term, this will further reduce, maybe in the next 1 to 2 years.
Your current gross and net debt and your operating cash flow, if you can, quantify that number for Q1.
So the gross debt, we had 177 crores of gross debt for this quarter. And in terms of net debt, it is close to around 65, 66 crores. Because we have an cash balance and also the investment in our mutual fund inventory. So net is around 65, 66, gross is around 177.
Right, and the cash flow conversion for the quarter?
Cash flow conversion for the quarter, we have been positive and is around 4 to 5 crores.
Sure. Thank you and all the best.
Thank you, Sujit.
Thank you. The next question is from the line of Sneha Talreja from Edelweiss Securities. Please go ahead.
Hi, team, and thanks a lot for the opportunity. Just wanted to understand, you said that, margins will normalize from quarter third onwards. What are the kind of margins that you look from quarter third onwards? And for Q2, are we expecting similar inventory losses to continue, or will there be fallen inventory losses given that your inventory levels have come down? Or is it that the price has fallen more? So just want to get some sense on margins here.
Yeah. So I'll take the second question first. So like I said, July has been the month of the sharpest decrease in terms of rupees per ton. So the sharpest fall will be seen in the July month. Having said that, we are working on a lower inventory than we did in quarter one. So I think margins should be in a similar range in the September quarter. And to answer your first question is in December quarter, our margins will begin to recover and normalize, which would be in the range of 13 to 15% as per our long-term guidance.
Understood. And with respect to demand, so how are you seeing demand trend? If I'm not wrong, agri is almost gone. How was the year and how do you see now, things panning out? Was there any substantial shift towards other polymers according to you, which can now come back to PVC? And your outlook of the volume growth does, if at all there is some recovery that you are believing?
Sure. So, Sneha, before I answer this question, just to build on the previous question, what I would like to highlight in terms of the PVC prices is that we are an industry which, of course, raw material cost is a large part of our cost structure, and any volatility in raw material will have a impact on margins. Having said that, this kind of a volatility that we have seen in the past couple of months has been, I would say, unprecedented. It maybe happens once every decade or once every few decades. So it's not that we are susceptible to such volatility every 2 or 3 years. This is a sort of a black swan event, and we obviously have been impacted more because of the inventory that we held, the higher inventory that we held, which was a conscious strategy to keep supply chain security. So this is a sort of an anomaly, a one-time hit that we have to take and move on. And to answer your question, we are not fazed by this margin pressure or inventory loss. We continue to be extremely bullish on the core business and on volume growth across segments, which in plumbing and SWR, the building material part of the portfolio, was already doing well, and now with a lower price regime that will continue to build, and agri will start to recover, because the past 2 or 3 years we have seen muted agri demand. With this kind of a price regime, I think across segments PVC demand over the next 2 or 3 years should be robust. And today we've set up those capacities in Jaipur and Telangana to take any advantage of uptrends in demand, and we are constantly working on the usual network expansion and brand visibility exercises. So we continue to be extremely bullish on demand in the medium to long term.
Got that, Nihal. Nihal, lastly, in case I may just squeeze in for your sanitaryware and bathware division that you have announced, what is the idea here? If I understood it correctly, you said asset-light model. So will that continue for how long? Any capex that you envision in this particular network, and what's the current network that is already dealing with, and what's the synergy that you see in this business, and in the sense that how much of your current network is already dealing with bathware products, and what's the direction here? Any numbers also that you want to give as a projection that what we should look at in this particular business?
Sure. So before I answer in detail, to give you a more big picture view, the rationale behind this diversification is to leverage the brand equity and the distribution network that we've built pan-India. We still continue to remain bullish on the core business, and that will continue to grow. But given that we today have the management bandwidth, both at the family and the professional level, and the balance sheet strength, we have decided to diversify into a business which is very adjacent to our core business. And like I said, our brand equity and distribution network has a huge scope to be leveraged in this business. A large part of our distributor network is already selling this product, and we have got very good feedback from our channel partners basis our announcement into this segment. It is very strategic for us to come front of the wall. Becoming a front of the wall brand helps us truly connect not only with plumbers but with homeowners across India, and this strengthens our connect to become actually a B2C, a genuine B2C connect. And we have appointed a seasoned professional, Harsh Kochar, as well as our existing national head in the pipes division, Ashok Mehra. Both of them have a combined experience of more than 20 years with the market leader of the bathware segment. And we have this is going to be an asset-light model, especially for the first 1 or 2 years. And we are in the process of shortlisting our outsource partners, and the finalization will happen in the coming time. Parallelly with that, we are also working on the design conceptualization, which is going to maybe materialize soon. And we are targeting a product launch in the March quarter. And it will be a phase-wise product launch. We will start with maybe 2 zones and then get the right feedback from the market. We are in no hurry to just drive numbers. We want to give the right product, the right design. It's a service-oriented business. We also recognize that this business is easier said than done. It's a business where some large players also maybe have not been able to do as well. So we recognize that. But basis our distribution network and internal management experience, we have taken this call. So we are in no hurry. We will be a phase-wise launch, and basis the feedback, we will become a pan-India player in this category. So yeah, hope that answers your question.
That definitely does. Thanks a lot, Nehar, and all the very best.
Thanks.
Thank you. The next question is from the line of Shrenik Bachawat from LIC Asset Management. Please go ahead.
Hi, Nehar. So my first question is on the PVC drop. Are we retaining any benefit on the PVC drop, or the prices are fully passed on to the consumer?
Yeah, thank you, Shrenik. Shrenik, in this industry, we usually pass on any increase or decrease to the channel with immediate effect. So when the prices were increasing, we would pass it on with full effect and in maybe 1 or 2 weeks time. So we cannot be unfair when there's a decrease. A similar business practice has to be followed in an upward and a downward trend.
Sure. And also, so our volume growth is around -2% on 3-year CAGR basis, which is similar to the industry leader, Supreme Industries. But I would assume now on percentage basis, our performance should be better going forward because of a lower base and also much higher distribution growth and new plant additions and various other measures we are taking. So is this a fair understanding that on percentage basis we should outperform the industry leader, or how should we benchmark?
Yeah, I mean, we will not only look at industry leader, but at all 3 or 4 players, really driving the industry today. And if you look at I don't know if looking at 1 quarter CAGR volume will be a right benchmark. I think the genuine volume growth has to be seen on an annualized basis. So if you see the past 3 or 4 years of volume growth CAGR, we believe that we have outperformed the industry. Having said that, we still are not happy with where we are. We are at maybe 6.5 to 7% market share, with the industry leader maybe being at around 12-13% market share. So we are still have huge potential for growth, not only in terms of geography, be it south and east, where we are ramping up distribution and retailer touch points, but also in terms of different product categories. Of course, in CPVC we have a large gap with the market leader. That gap has closed down in the past 1 or 2 years, but still a lot of work remains to be done. And we will be launching a few new products within the piping segment itself, which we think will help us cross-sell and ramp up market share in the piping vertical.
Sure. And could you throw some light on the CPVC pricing? Any change on CPVC pricing or what's your outlook there?
I think CPVC prices have stabilized. There was an increase in the past couple of quarters. And now I think CPVC prices will continue to remain at current levels. I don't see any imminent increase or decrease going forward.
Sure. Thank you.
Thank you, Shrenik.
Thank you. Next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir. My question pertains to first on the volume numbers. Could you give some guidance for FY23? What sort of volume numbers you're looking at?
Yeah, thank you, Rajesh. I think in terms of volume, I think the second half of the year will be better in terms of operating performance, not only in terms of volumes, but in terms of earnings as well. Will recover from the second half of the year. The first half of the year has been impacted by the sharp decrease. And like I said earlier, that not only impacts the margin performance, but it also impacts volumes because of the uncertainty and the negative sentiment in the channel. There is a phenomena of destocking that is especially happened in the first 4 months of the financial year. I think things will stabilize from here on and then start improving from the October to December period. So I think maybe at the end of the second quarter, we will be in a much stronger position to give a firm guidance for FY23.
But any 10%, 15%, any broad outlook which you're looking at?
Yeah, like I said, I think we'll stick to the second half of the year being much better in terms of volumes and earnings. First 4 months have been impacted by the sentiment. So like I said, at the end of September quarter, we will be in a much better position to give guidances on volume. What I will say is on a medium to, I understand what you're trying to ask. So on a medium to long-term basis, volume growth should be there for the industry overall. And I think we will be leading the industry volume growth as we have over the past 3 financial years. We will be leading the industry growth. That's the internal target. And I think it will be possible given this lower price regime and then internally the capacities that we've set up to take advantage of any uptrends in demand. So on a medium to long term, there's double-digit volume growth is definitely a achievable or a realistic target for us.
So when I look on a trailing 12-month basis, a 3-year CAGR, indeed you are growing at 11% CAGR, which is relatively better off given the industry has not been doing good. So we want to continue with the Lubrizol brand tie-ups that you have. What sort of benefit you have seen on your volume push, and do you expect this growth can firm up here on?
Yes. This is obviously the Lubrizol tie-up is in one category, which is for CPVC. Overall, in volume terms, end of the day, it is only maybe 11 to 13% of our overall volume in metric ton basis. So that will have a positive impact, and it's not only the Lubrizol tie-up. Apart from that, we are doing a lot of other initiatives to grow overall, not only in CPVC, but in the overall building material space. FlowGuard is just one small part of a larger overall strategy. Lubrizol may be more helpful in the B2B space, but in B2C, end of the day, Prince is still a larger brand where we need to do other initiatives. But yes, I think going forward, growth will be led by plumbing and SWR. And like you correctly pointed out, over the past 2-3 years, we've been doing better off than industry. And again, to repeat, we are still not happy with that. We need to perform better, and internally we are aspirational. And over the past 2-3 years, we will deliver on that.
Okay. And sir, given the inventory loss you mentioned, you have already incurred 30 odd crore, in Q1, and given that post June end there has been further sharp fall, from June end pricing, the current realizations from 117 rupees, they are another further down by 20 odd rupees, more than 20 rupees. So are we looking at similar inventory losses in Q2, and hence, or how should we read the numbers? Because the 13 to 15% EBITDA margin, which you're talking about, which you can sustain through Q3, Q4, that still works out to be close to 20 rupees a kg type of EBITDA margin. So Q2 also will have a similar EBITDA per kg, which we have done in Q1.
Yeah. So, as I stated earlier, Rajesh, there are two variables here. One is the per kg drop, which has been sharp in July, as we pointed out.
Correct.
Which will, ensure that September quarter margins are under pressure. Having said that, inventory levels are slightly lower than what we had at the beginning of the first quarter. So I think I would stick to a similar sort of operating margin performance as of now. We'll have 45 days, more than 45 days of the quarter left, but should be a similar performance as the first quarter.
Okay. And one last question. If I look at pre-COVID margins, we are around 17-18 rupees a kg, and last 2 years have been very strong for you and as well as the industry. So going forward, what could be the normalized number? Is that 18-20 rupees is the normalized EBITDA margin which one should build into, or there have been significant changes in the product mix whereby you can go up to 25 rupees or even 30 rupees? What would be the normalized number one should look at?
So I think, Rajesh, we have typically always stuck to margin guidances of 13 to 15%. Of course, there's better product mix, better pricing power in a consolidating industry will help us improve margins over the long term. And as volumes grow, profitability will grow. Because of the way our cost is structured, there will be a good amount of operating leverage as well. So I would, stick to a long-term EBITDA guidance of 13 to 15.
Okay. Great, sir. Thank you. I'll come back in queue.
Thank you, Rajesh.
Thank you. Next question is from the line of Praveen Sahai from Edelweiss Wealth Management. Please go ahead.
Thank you for taking my question. Just a query on the volume side. As I believe the agri contributes around 35% of the volume. And as you also said that the agri is a weak, plumbing has done well for a sector. But still I look at the peers, whoever has reported their numbers in volume, your numbers